Good day, everyone. You're welcome to this week's Business and Investment Tips Program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. This week, the focus is on April 2026 inflation report. Inflation rises, but monthly pressure eases. The National Bureau of Statistics released the April 2026 Consumer Price Index report, and the numbers present a mixed picture. Headline inflation rose to 15.69% year-on-year in April, from 15.38% in March, indicating that inflation is still trending upward. However, on a month-on-month basis, inflation slowed sharply to 2.13% from 4.18% in March, suggesting that although prices are still rising, the pace of increase moderated significantly from the previous month. In simple terms, prices are still rising but not as sharply as in March. Food inflation remained the biggest concern. It rose to 16.06% year-on-year in April, up from 14.31% in March, confirming that food prices remain a major pressure on households. However, month-on-month food inflation slowed to 3.63%, down from 4.17% in March, indicating that food prices continued to rise, albeit at a slightly slower pace. The increase was driven by items such as millet, yam flour, fresh ginger, beef, gari, yam tuber, pepper, crayfish, cassava, beans, Irish potatoes, tomatoes, wheat, soybeans, guinea corn, plantain, and carrots. Core inflation, which excludes volatile farm produce and energy, offered a more encouraging signal. It fell to 15.86% year-on-year in April, down from 16.21% in March. More importantly, month-on-month core inflation slowed significantly to 1.03% from 4.03% in March. This suggests that broad-based pressure across goods and services eased in April, even though inflation remains elevated. Looking at the key drivers, food and non-alcoholic beverages contributed most to headline inflation at 6.40%, followed by restaurants and accommodation services at 3.56%, transport at 1.70%, health at 1.21%, and housing, water, electricity, gas, and other fuel at 0.77%. On a month-on-month basis, food remained the largest contributor, followed by restaurants and accommodation, education, housing and utilities, and health. This shows that inflation is still largely driven by essential spending categories that households cannot easily avoid. Urban inflation stood at 15.40% year-on-year, while rural inflation was higher at 16.36%. On a month-on-month basis, urban inflation slowed to 1.86%, down from 3.16% in March, while rural inflation is to 2.80%, down from 6.73% in March. Although rural inflation eased significantly, it remained higher than urban inflation, suggesting that rural households are still facing greater pressure from food prices, logistics, and distribution costs. The sub-indices provide deeper insight. Energy inflation rose to 8.0% month-on-month, up from 6.6% in March, underscoring the ongoing risk to the inflation outlook. Imported food inflation also rose sharply to 4.4% from 1.1% in March, indicating renewed pressure from external food prices and possible exchange rate pass-through. However, goods inflation slowed to 3.2% from 5.5%, while services inflation eased to 2.1% from 2.6%, suggesting some moderation in broader price pressures. At the state level, inflation remained uneven. Headline inflation was highest in Sokoto, Bauchi, and Zamfara, while Edo, Borno, and Jigawa recorded the slowest increases. For food inflation, the highest increases were recorded in Enugu, Kwara, and Adamawa, while Borno, Jigawa, and Taraba recorded the slowest increases. Overall, the April inflation report suggests that Nigeria's inflation path remains fragile. The slowdown in month-on-month headline, food and core inflation is positive, but the rise in year-on-year inflation, energy inflation, and imported food inflation shows that risks remain. Higher energy prices, partly linked to ongoing global tensions and higher crude oil prices, can feed into transport, logistics, and production costs, which may keep the prices of goods and services elevated in the near term. Investment strategies to hedge against inflation. From an investment perspective, this environment still demands discipline, diversification, and appropriate asset allocation. Investors should avoid leaving excess funds bonds in low-yield accounts as inflation remains above the return on most savings products. Treasury bills, FGN bonds, and other high-quality fixed-income instruments remain attractive for preserving capital and locking in current yields. Given the pressure from energy and imported food inflation, investors should also maintain a balanced currency strategy with some foreign currency exposure where appropriate. In equities, the focus should remain on fundamentally strong companies with pricing power, especially in banking, telecommunications, energy, cement, and essential consumer goods. This remains a market for gradual accumulation of quality assets, not speculation. Thank you for listening. Please join us same time next week for another interesting and insightful session. For questions, comments, or feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 07082463747. Stay blessed and have a great week. Bye.